Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading report for May 6, 2017. We have a market that is in bullish quiet, which is favorable for the long side and swing trade opportunities. On an annual basis, using the weekly RSI 14, we just entered the overbought zone at 70 out of 100. Shorter term, using the 10-day NDX, we are deeply overbought at 100 out of 100, ready to break out to all-time new highs. In the market, Mosaic price with respect to the 200-day moving average is white bullish at 7.51%, meaning that we're 5.5% above the sideways zone. The slope of the 50-day moving average is red bearish at 0.17, meaning that this is among the weakest readings of the 50-day moving average in the last 6 months. We're going to see that it's in a transition state at the end of a long 90-day gain, which consolidated and is just getting ready to start. So the 50 gives us a slightly negative reading here, but we'll see that some of the shorter term indicators are pointing to the possibility of a significant upward trend of 8 to 10% in the next 3 weeks. ADX 14 is at white neutral at 21.6. This is an improvement over last week, which was around 15. So the strength of trend is increasing. It's not strong yet, but it's just beginning. And the bulls are in charge. And that means that there's room for a 2-week upward trend to occur. There's enough room in the index to do that. It's not overheated yet. And that's where the possibility of 8 to 10% comes from. The risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. Current reading is at 1.172, so we're deeply into risk on. We take that score and look at the last 5,000 trading days, find the average and standard deviation, and compute the risk Z, or the Z score of volatility, and that comes in at 1.85. Here you see a 90-day histogram of that indicator, and after a long period of sideways chop, we had a sharp threat for a sell-off, which immediately reversed, gave us some clear indications for upside potential, and volatility has decreased to the point where it's at 2Z, above average. Just started to roll over at the top. And so what that warns us is that if there is such a thing as easy money, it may have already been made, but that we've got to be prepared here for sharp reversals against the run of play, against the trend. And with the market at all-time highs, that wouldn't be a surprise as people want to lock in their excess gains at the first sign of weakness. So we'll be sensitive to that in the next couple of days as the market is at the boundary of all-time highs. You can see here the blended monthly rebalancing holdings for ETF 13, 22, and 32, with technology and Europe in the lead, and the Dow 30 close behind. And then in the current leaders section, you can see the leaders as of closing price on Friday, no change. And then among the leaders among the Dow 30, ETF 200, and ETF Max. In the ETF Max, it's important to notice the strength in Europe with Greece and Poland represented, along with Italy, EWI. In ETF 2, the theoretical model is exposed at 100%. The model portfolio is at 100%, so all systems go from there. This is a quick look at the ETF 13 and 32 portfolios from blended monthly rebalancing. You'll notice that in ETF 13, all of the indexes are above their 4-month moving average, and so they are all on buy signals, with the best strength in the Euro-Asia blend, Japan, and U.S. technology. Asia less Japan and Australia are lagging. In ETF 32, again, it's the European 350, U.S. technology, the Euro-Asia blend. So it's these large caps that are leading the way. The only thing in cash are the commodities, such as gold, agriculture, energy, and then the blended commodities, and then along with China as well. In ETF 32, what I'm looking for are those relative strength leaders, which are green across the board, like European 350, who also had an excellent 1 month and 1 week performance. I'm looking to take advantage of continuation of momentum or sharp reversals as people try to lock in gains. I'm also looking for those that are in red on the 1 week and 1 month. That may either be the gateway to more pain ahead or creates an opportunity to buy quality on dip. So I'll be stalking Australia and Asia less Japan for those reasons. In ETF Max, no clear sell-offs among any of the relative strength leaders. A little bit of weakness in India creeping in after an extraordinary 1, 3, and 6 months. But the globals are represented well here, and it looks like full speed ahead going into the week. In the S&P 500, I'm very interested in position 1, VRTX, which is green across the board on 3 and 6 months, but shows a slight weakness on 1 month and then significant weakness on 1 week. And so that may be the end of their run and an opportunity to play downside momentum. Wynn Resorts is an outstanding swing candidate, and so I like the fact that it has long-term strength and short-term weakness. That creates a play that can go in either direction depending on where the traders want to take it. And since that's one of my favorite swing and intraday candidates, it goes to number 1 position of interest on my watch list. In the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. The thick blue line is also 60 days look back. The horizontal red lines are resistance levels that were once support levels. And if current support is broken, those become price ladders for movements back towards the 200-day moving average. You can see that the slope of the 10 period is solidly up with price in the middle of that channel, not overbought on that sense. The RL30 is back to sloping upwards, and price is in the upper half, so that is favorable. And you'll notice that the slope of the 30, which is represented by this sine wave, briefly got below the 0 line where it crossed at the first blue dot, got as steeply down as 0.05, which is hardly, it's just basically a dip, and then immediately corrected and is now marching northward. At a current reading of 0.1, that means that there's still plenty of room for this move that is beginning to emerge from the river. Plenty of room to the upside, and since this is near an all-time high, that leaves a potential move of 8 to 10%, well within range based on normal technical indicators. You'll see that we've been oversold for 10 days on Williams percent R. That can persist for a while. And that the jaws of the percent price oscillator are open to the upside, and that is favorable as well. So everything is in place for a move to the upside on a swing term basis, and so I'll be prepared to go in that direction, but I'm also cognizant of the downside risk, and I'll be prepared on the intraday trading to hedge my long positions by being sensitive to short-term weakness. This is a summary of the ETF2 regional report. All 10 indexes are on buy signals. You'll see strength leaders there in IEV, the Euro 350, and then US Tech. The only weakness on the board there being Latin America. Among the US sector spiders, strength in technology, weakness in energy, but everything else in the US remains above average. In the world market model, everything in the US, again, above average. US Tech in the green. Japan and Asia less Japan are both above average. Real strength across the board in China, especially in China and India, and then the other Asian countries are generally above average. A little bit of weakness creeping into Latin America and the emerging markets in Canada and Brazil. Great strength across the board in Europe. And you see also that the tech sector is strong both in the U.S. and overseas. In the ETF Top 30 database, Strength leaders: Spain, Italy, internationals, France, European 350. You get the point. Those that are green in the strength and white in consistency are new to the front of the pack, and so I'm looking for more strength to come from them. And that's the European stock from Vanguard. Germany is just getting to the front, as is Switzerland. In the Dow 30, strength leaders remain Apple, McDonald's, Boeing, and Home Depot. Uh, Laggards, Chevron, and IBM. And then emerging strength, green and white, in Walmart, United Tech, Caterpillar, and Microsoft. Declining strength are those that are in the white on strength and green on consistency, and that's DuPont, Visa, Morgan, Disney, and American Express. The volatility chart shows the top 30 most liquid ETFs on the basis of average daily dollar volume. And then in the ATR percentage, those in the green are the ones that are exceptionally volatile compared to their peers. And in the red, high yield corporate bonds is so lacking in volatility that it is a poor day trading candidate. But if it's green in the ATR percentage, that means it's well suited for day trading. Shifting to the daily, you'll see we have plenty of auto framer signals to frame. A couple channelings and an overreaction and a 551W. You can see the decline in volatility that gets us to bullish quiet. The slight increase in ADX strength with the bulls in charge. No signals in channeling and overreaction. Daily tactical summary, half a dozen dojis, a couple channelings, and then 7 different symbols test out well on the auto framer, better than 2 to 1, so that's a target rich environment. A handful of frog quality numbers greater than 3, and then a couple of RSI 2s in single digits for early washouts. The way I would approach this then is IBM is an excellent candidate at number 3 on MPRC, tests out at 2.7 to 1. It was a big percent loser on Friday. Its RSI value is 2, and it's been significantly underperforming its peer group in the Dow over the last 1, 10, 30, 90, and 180 days. So this is a candidate for getting short on weakness, but being prepared to get long if the market is up, if tech is up, and then IBM is doing better. This may be a sign of a potential tactical opportunity there. In the ETF 30, very few mechanical signals. However, lots of auto framer that's better than 3 to 1, including gold at 9 to 1. A bunch of frog quality numbers better than 3. And silver, gold, and the VIX, metals and mining near the top of the stack. In the auto framer, again, we've got more than a dozen quality setups, and you have all the framing data that you need to work there. I'll be looking at Procter & Gamble, Disney, and IBM. And then in the RLFF, the top shelf in the green are those symbols that are the most ATRs below their own RL270, and that gives potential for either further collapse or a reversion to the mean that's favorable. The bottom shelf in the red are the relative strength leaders. These are the ones that are the most ATRs above their own RL270. I'll be looking for continuation patterns of continued outperformance from those. The daily squeeze represents symbols that have had a large average range but which compressed tightly one day on Friday. And so I set this up so that if it exceeds yesterday's high, I have an opportunity to get long for a one-day large pop, using the other side of the daily range as an initial stop. So things of notice on there: Abbott Labs, Monsanto, and Pepsi-Cola. In the market mosaic, I'll just highlight for you that the long sideways channel that brought the slope of the 30-period regression line down and brought volatility down has started to resolve to the upside. You can see the beginnings of a move starting to unfold, and that's why I think another 8 to 10% is on the table should everything go well. Longer term, I want you to notice in chart number 6 the that the standard deviation of price um, has bottomed out and started to improve, and that's why I have some belief on the long side for uh, trading opportunities. The fail stat for your review, and you can stop the video if you need to. The gain stat, the gap stat, and the signal to noise ratio. I'm going to look ahead to the z-scores of 3 different regression line slopes, the 10, the 30, and the 90. What I want you to notice on the top chart is on the 90, it bottomed out below the 0 line, came out of the yellow zone at z plus 1, and then made a steady continuous move to where it peaked a couple months ago, and then has steadily declined and then flattened out currently. The 30 period at that time has oscillated twice and has recently visited below the 0 line and is now starting to climb. And the fact that we're seeing price improvement in the indexes, and yet the 30 is still below its longer-term average. This is healthy and promising for the next leg up. If you look at the price chart below, you'll notice that the last time that the market penetrated outside of the river, it reversed and then had a long, significant climb from 215 to 240. And that this time when the market came through the river, it barely penetrated and then resumed its march sooner. And so because we're at all-time highs, the possibility for another 8 to 10% is available. These are the frog statistics for your review. And that's everything I wanted to cover on the daily. Except for this last chart. This is a new chart where I'm showing some insights into blended monthly rebalancing volatility summaries. And you can see on the right-hand side of the black line the performance characteristics of different groups of ETF portfolios. And I want you to notice that the ETF 13, the most conservative, has a strong average move in multiple time frames, but really doesn't experience anywhere near the downside volatility that you find in ETF 200 or ETF Max, in which case some specialty or outlying ETFs and stocks can really be painful to own. And so one of the trade-offs you get with just trading the ETFs is that you get longer, smoother, but less volatile moves, which you can actually engineer more carefully. When you shift to the smaller, more volatile ETFs and then start adding elements of the S&P 500, your opportunity for upside gain is enhanced dramatically, but as is the risk. And so the wider you go towards individual stocks and away from the broad indexes, the more heat that you have to be able to stand. All right, so that's everything I wanted to show for from the weekend report. Here's a couple trade frames that we worked up this weekend in the workshop that we wanted to share. Here's one from Jim Diaz, who looked at a Z3 pinch on the hourly charts on the Qs. You can see the vertical blue line where he starts stalking it. We've placed a 3 frog box risk box, or a weekly frog, around the Z3 lines, and we'll be ready to go long if it leaves the yellow box. And then 2 boxes of gain ahead are very reasonable, since that's already at an all-time high. There's nothing to slow it down except fear itself. And then if it breaks down out of the yellow zone through the red line, we'd be short. And then the first box of risk gets us to the RL 270, and then the remaining red lines become places where we've seen measured support before, and that gives us a stair-stepping ladder of price targets on the way down. In McDonald's, we took a look at this one. I'm not sure that it's quite ready yet on daily charts, but you'll notice here that price is out around Z2 after a nice big gap up 7 or 8 days ago. It never has failed yet, um, and so it's well postured to follow through. It closed at an all-time high. I would be ready to buy a breakout from the new high. I would put the stop at the one at a 2-day low at the northern skin of the dragon. Um, and then you can see the other support and resistance lines as indicated. But McDonald's is one of the relative strength leaders that could really go. And then finally, this is American Express. We've seen two unambiguous moves, um, followed by this owl entry that has brought price all the way back to the Bollinger Band mean, and then compressed into a tight daily range. And so we framed that one as a bi-directional trade, ready to go long at the green line or short at the red line, with a trailing stop the size of the yellow box. And you can see to the upside that we're targeting the Z2 and Baby Dragon as a price target, and then the Z3 line as an upside target. Downside, we're looking at the belly of the dragon, which would be a collapsing dragon if it violated, and then the belly of the Baby Dragon, or the RL10, for our secondary target. I would be adding a second position on this one if it breaks down through the second purple line, or a second position if it broke above the top the top purple line. So just a couple trade frames to share from the workshop. Be heading out here shortly. Wish everybody safe travels. Take good care of yourself. Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.